Hello, and welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies for MetaTrader 5 and study how they actually think. Today we're looking at an expert advisor called Volume Imbalance Persistence Trend. It's a trend-following system built around an original oscillator called the Directional Volume Imbalance, which measures whether recent trading volume has been landing mostly on up bars or down bars. Over the next few minutes, we'll explore how it reads participation, how it confirms the prevailing trend, and how it manages every position. This is educational content only, so let's dive in and learn together. So what does this expert advisor actually do? At its heart is a single, focused question. Over the recent window of bars, has the traded volume been landing mostly on green candles or on red candles? To answer that, the strategy builds an oscillator called the Directional Volume Imbalance, or DVI for short. For each closed bar, it assigns a side. If the candle closed above its open, that's a +1. If it closed below its open, that's a -1. A perfectly flat doji counts as 0. It then multiplies each bar's side by that bar's tick volume, adds those signed values together, and divides by the total volume over the window. The result always sits between -1 and +1. Near +1, almost every unit of volume printed on green candles, meaning buyers were clearly in control. Near -1, the volume stacked up on red candles, so sellers dominated. Near 0, participation was split, with no real edge either way. This is deliberately not money flow or balance of power. It cares only about the direction of each bar's body and how much volume backed it. Now, a one-sided read on its own is not a trade. The strategy asks for two more things to line up. First, a trend filter. The slope of a price-moving average must point the same way, so the system only takes participation bursts that agree with the prevailing drift. Second, an event. The oscillator must actually cross its threshold on this bar, turning a lingering state into a discrete signal so the strategy doesn't re-enter every single bar while the regime holds. This approach is generally suited to a patient, trend-following style on liquid instruments like major currency pairs, metals, or indices, where tick volume is a reasonable proxy for participation. Remember, this is educational information, not financial advice, and trading always involves the risk of loss. Let's walk through the logic step by step. The expert advisor works on closed bars, so it evaluates everything once, when a fresh bar completes, and ignores the noise of every tick in between. On each new bar, it recomputes three ingredients. First, the directional volume imbalance over the look-back window, which by default is 20 closed bars. Second, a trend moving average and its slope, using an exponential moving average with a default period of 50. Third, the average true range, over a default of 14 bars, which measures current volatility. Now for the entry conditions. For a long, three things must agree. The oscillator must cross upward through the positive threshold, which defaults to 0.20. That threshold represents roughly a 60-40 tilt of volume toward buyers. Notice it must cross, not simply be high. The previous reading has to be at or below the threshold, and the new reading above it. At the same time, the moving average slope must be positive, confirming an upward drift, and the signal bar itself must close green as a final confirmation. When all three line up, the strategy signals a buy at the ask price. For a short, the mirror image applies. The oscillator must cross downward through the negative threshold, the moving average slope must be negative, and the signal bar must close red. The strategy then signals a sell at the bid. Risk management is built in and self-scaling. The protective stop is placed 1 ATR multiple away from entry, using a default multiplier of 1.6. Because it rides the average true range, the stop naturally breathes wider when volatility rises and tighter when markets calm down. The take profit sits at a multiple of that stop distance, set by the reward ratio, which defaults to 1.8. So the target is 1.8 times as far as the stop. The expert advisor holds just one position per magic number at a time, and it skips new entries whenever the spread is wider than the maximum spread setting, avoiding thin conditions. Once a trade is open, the stop and target manage the exit entirely. As always, this is educational only, and losses are a normal part of trading. Let's read through the code as it appears in MetaEditor. At the top are the input parameters you can adjust in the strategy settings. The imbalance period sets the look-back window for the oscillator, defaulting to 20 bars. The imbalance threshold, at 0.20, is the level the oscillator must cross. The trend EMA period defines the moving average whose slope sets our trend direction. The ATR period and stop multiplier shape the protective stop, while the reward ratio scales the take profit. There's also a maximum spread filter, a lot size, and a magic number. Below that, we compute a couple of helpers, the threshold and the stop distance, which is the ATR multiplier times the current ATR. Now look at the two signal conditions. The long condition checks that the previous oscillator reading was at or below the threshold. The new reading is above it. The moving average slope is positive, and the bar closed green. When that's true, the code reads the ask price, sets the stop distance below entry, sets the take profit at the reward ratio times the stop above entry, and calls trade.buy. The short condition is the exact mirror, the previous reading at or above the negative threshold, the new reading below it, a negative slope, and a red bar. It reads the bid, places the stop above entry, the target below, and calls trade.sell. Both sides are symmetrical and fully protected from the moment they open. Let's bring this to life on the chart, walking through a long trade, and then a short trade, candle by candle. Along the bottom, you can see the directional volume imbalance oscillator, with its dash lines at plus 0.20 and minus 0.20. On the price chart itself, the blue line is the trend EMA. Look at the first few candles. Price is drifting gently higher, and the blue EMA is sloping upward, so the trend filter already favors the buy side. Meanwhile, down in the oscillator, the DVI is low and quiet, sitting near zero and below the plus 0.20 level. There's no real one-sided participation yet, so the strategy simply waits. Now watch the fourth candle. It closes as a strong green body, and at the same moment, the DVI jumps from below the threshold up through plus 0.20. That's the crossing the strategy is waiting for. Volume has tilted firmly toward buyers. The EMA slope is pointing up, and the bar itself closed green. All three conditions agree, and the buy entry marker appears. The stop is placed one ATR multiple below entry, giving the trade room to breathe, and the take profit sits farther away at 1.8 times that stop distance. Over the next candles, price follows through, printing higher highs as buying pressure persists, and the DVI climbs toward plus 0.8, confirming that participation stayed one-sided. By the seventh candle, price reaches the take profit target, and the long trade closes in the green. Now the character of the market shifts. Around the top, candles begin closing red, and the blue EMA rolls over and starts sloping downward, so the trend filter flips to favor the sell side. Down in the oscillator, the DVI slides quickly from positive territory. Watch the 10th candle. It closes as a firm red body, and the DVI crosses down through the minus 0.20 level. That's the mirror signal. Sellers now dominate the recent volume. The EMA slope is negative, and the signal bar is red, so all three short conditions align, and the sell entry marker appears. Just like before, the protective stop is set one ATR multiple above entry, and the take profit sits 1.8 times that distance below. Price then works steadily lower, candle after candle, as the DVI deepens toward minus 0.8, showing that sell-side pressure kept building rather than fading. By the 13th candle, price reaches the downside take profit target, and the short trade closes. Notice what made both trades consistent. In each case, the strategy did not act on volume alone, and it did not act on the trend alone. It waited for the oscillator to genuinely cross its threshold, for the moving average slope to agree, and for the signal candle to confirm the direction. That combination is what turns a lingering imbalance into a single, defined entry, rather than a stream of repeated signals while the same regime persists. Of course, not every setup plays out this cleanly. Markets can reverse right after entry, and that is exactly why every trade carries a predefined stop from the moment it opens. This walkthrough is an illustration for learning purposes, not a prediction of results. And that brings us to the end of our look at Volume Imbalance Persistence Trend. Today we unpacked the Directional Volume Imbalance Oscillator, saw how it reads whether volume is landing on up bars or down bars, and watched how the strategy combines that reading with a trend filter and a confirming candle before taking either a long or a short. We also covered how the ATR-based stop and the reward ratio target manage every trade. Remember, everything here is educational information only and not financial advice, a recommendation, or a solicitation to trade. Trading involves real risk, and losses do happen. If you found this helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment with the strategy you'd like us to analyze next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.